Hi, my name is Jordan Wilson. We continue our look at things you should consider when you assess potential financial advisors. Today we're going to look at the personal fit and the service offering. In our objectives, we've previously covered technical qualifications, how it's nice to have, and in some aspects, yes, it is important, but you also need the experience side, which we covered in the next episode. What's right for your needs, both today and in the future? Today we're going to cover the personal fit side, type of client, investment philosophy, service offering. And we'll finish up in the final episode with a look at the different fee structures and maybe some of the pros and cons of each. The first point in personal fit is type of client. And you can look at that from 2 or 3 different ways. The first would be, what is the typical type of client that the advisor deals with? Maybe they're a generalist and they deal with people from ages 8 to 80. But often you see advisors focusing in certain subsectors. I'm a certified financial planner, so I do financial planning. But maybe my focal point is the retiree segment. So I'm concerned with planning as far as creating positive cash flow to supplement pension income. Maybe I'm looking at estate planning, will creation, inheritances, lending money to grandchildren to buy a house. On an investing side, I'm probably interested in preservation of capital, looking at generating interest income or dividend income. I'm not really thinking about 40-year time horizons for investments and taking on added volatility. So if I'm a 25-year-old individual looking for a 45 or 50-year time frame for their retirement planning, maybe it's not the best match. Or conversely, if I focus on the entrepreneurial market segment and I'm looking at placing venture capital and private equity with these type clients because they understand those investments. Again, maybe not a great fit for a retiree couple. So you want to sort of match maybe any specialization areas. The other thing that you want to look for is type of client as far as size or concurrently importance. If I am a 20-year-old, 25-year-old just starting out, and I've got $20,000, I want to be just probably into low-cost mutual funds, exchange-traded funds, these type things. Now, if the client advisor, whether that be a CFP, a tax accountant, investment advisor, any of these things, if they specialize in clients that are in the $5 million, $10 million range and are engaged in more sophisticated and costly investment strategies or tactics, again, maybe it's not a great fit as far as the level of service goes or the specialization again. So size can dictate how things are done, and that can impact you whether you're the person with 100,000 and the advisor deals with people with 5 million, or you're the one with 5 million and you're trying to work with an advisor who's used to dealing with people with $200,000. And then that importance factor you always have to ask yourself is, during tax season, during year end, when it's busy, how fast will my advisor return my calls or my emails if I have $100,000 with them and the rest of their clients are 5 or 10 million? So you have to ask yourself, how important am I going to be in the priority list for that advisor? Just some considerations on matching your needs to who the advisor usually deals with and make sure that you're in that range. The philosophy, the investment philosophy, I think that's another very important aspect. As an advisor, how do I think you should invest? Now, if you come to me specifically and you have, let's say, under $1 million, under $2 million in bankable assets, I will, in most likelihood, ultimately recommend a strategy of low-cost passive investing. Index ETFs, exchange-traded funds, maybe mutual funds, depends on your banking and financial institution situation. But that tends to be my focal point. And I believe that we should spend our time on your investor profile, who you are, what your needs are, what your constraints are, what your risk tolerance is. Use that to drive your target asset allocation, because I believe that that's more critical to long-term investment success than the actual underlying holdings. And then we try to match the market, minimize costs, and we look at sort of things like buy and hold versus trade, how to build portfolios. Should we lump sum invest or should we dollar cost average, maximizing the use of tax deferred and tax free accounts? So that's a sort of philosophy that I tend to have. Now, if you have a critical mass, say over 2 million, we can create well-diversified portfolios on a cost-effective basis, maybe with individual assets. So maybe we start moving away from the ETFs or the funds. But if you're a client or a potential client and you're only interested in buying and selling Amazon, Google, Facebook, Bitcoin, GameStop in this month, then you might not really feel like my strategy or my philosophy meets what you want to do on a daily basis. So I think you got to find a fit as far as the investment philosophy. And I think you need some open-mindedness in that, because there's a good chance that whoever you're assessing probably has some expertise, whether it be tax or investing or budgeting or just general planning or insurance. And so you do have to give a little bit of deferral to their knowledge and experience. But again, on a bottom line basis, if you're the person that wants to invest in Bitcoin and short Tesla or things like that, then a more passive buy and hold philosophy won't be a good fit for you. Conversely, if you're a retiree who are concerned about safety of capital and generating positive cash flow, and your advisor is trying to push you into private equity or venture capital or Bitcoin, also not a good fit. And in that case, you'll be the one staying up all night eating antacids because of the stress. So can work both ways. Another area is the process. And I mentioned that a bit earlier, is are we going to actively trade? Are we going to buy and hold? How are we going to create and maintain our portfolio? Or how are we going to develop tax strategies? Or how are we going to develop adherence to a budget? So that's areas that you got to find. And there's got to be some realism. One example I always think about is budgeting. So I always read about these things where if you cut out your daily Starbucks coffee, you can save $5 a day. 5 times 5 is 25. So you're saving, 100 plus bucks a month, and you'll invest that. Now, that is true, but you are not buying Starbucks coffee because it's economical. We both know that you can get cheaper alternatives that are just as good. You're buying Starbucks for a different reason. And so if I'm the sort of advisor that is trying to convince you of cutting out your daily Starbucks to save $5 and then investing that at the end of the month, again, is that a good fit? Are you the sort of person that's suddenly going to say, oh, gee, Jordan told me that if I cut out my Starbucks on a daily basis, I can now invest $100 a month. I think I'll do that. That's not the way people change behavior in many cases. So again, you've got to have a bit of a realistic process. The final point I just wanted to make here is the relationship. I'm sure there's better terms to use, but I put down warm fuzzies. This is in some ways, financial advice is kind of intimate in the sense that you're often disclosing things about your personal affairs to the advisor. And you're opening up, and you want to sort of have a relationship built on sort of trust, and you want to like each other. So I think that's important, that you deal with an advisor who you do feel comfortable sharing details. And those details may be, I'm planning to get married in 6 months. We're planning to start a family in the next 3 months. And the more information that your advisor has, the better that they can plan and make recommendations to help you achieve those goals. And again, it's one of those things where if you do things after the fact, it's often too late. But if we do it while you're in the planning phase, things can often be set up to take advantage of this. And the example here might be, if we're doing an investor profile for you, and you don't tell me that you're getting married in 6 months and you're going to buy a house in a year and start a family in 18 months. And all I'm thinking about is you're 28 years old and you've got a 45-year time horizon for your retirement. So I'm focusing entirely on the long haul, whereas I should be thinking, okay, this individual has short-term, high priority investment or financial objectives. And we have to build that into our target asset allocation so that they have adequate liquid funds on hand to pay for the wedding, to pay for the down payment on the new home, to maybe set up an RESP or some other children's education funding. So you do want that relationship where you have a comfort level and you like each other. The other comment I'd make here is Do you want a partnership or a one-way street? And I'm a little biased here because I believe firmly that the client-advisor relationship, whether it be planning, budgeting, tax, insurance, it has to be, in my opinion, a true partnership, a collaboration. And I don't enjoy dealing with my dentist, my doctor, any of my professional advisors who are saying, thou shalt do this, this, and this. I think from my side as an advisor that if you can be part of the process, so you understand what's going on, and then you can contribute to the discussion, and ultimately you buy into what's been mutually agreed upon as far as, say, an investing course. And that's part of what we're doing here in these episodes is as you increase your knowledge base, you can make more informed and they're hopefully better decisions, which will lead to better wealth management outcomes. And the example I tend to use is covered call options. For a lot of people, derivatives, options, unfamiliar, and unfamiliar often means risky. But in practice, many investors use covered call options to, let's say, lock in unrealized gains on equities they own. Or they write a call option to generate some income to their portfolio. Two areas that are actually risk management instead of being high risk. But if you don't understand what's going on, that lack of familiarity may create the idea it's risky. And again, the more we understand about risk return, standard deviations, investment returns, diversification, asset correlations, we build that knowledge base, which allows us to make better decisions on what type of assets to put into our portfolios, how to build the portfolio over time. So that's what I'd rather see with my clients is an investment in them to build their knowledge base allows us to do more down the road. And I think that's very useful. And that's just something I think I like. I think most people should like, but it's just something, to consider when you're meeting with a potential advisor is how is our relationship? Is it a partnership, a collaboration, or is it basically the professor at the university lecturing? And then we move to the service offering. And one of the things is the products. Now, hopefully you'll find a service provider who provides products that meet your needs. And when we're talking products here, we're probably talking in-house products. If you're with a bank, maybe bank mutual funds. If you're with a mutual fund salesperson who works for a fund company directly or indirectly, their internal products or proprietary products. Often those products or the advice to purchase those products is free, but you end up paying indirectly either through sales commissions and or through advisory fees that are embedded within the management expense ratios that you pay on an ongoing basis for those products. Or maybe you're working with someone, say in my case, like me, where you pay directly to the advisor for advice, and then they offer you what I call best of breed products, which would be what the advisor thinks is the best in the class, and it doesn't matter who produces them. And I think there's pros and cons to these. And when we look at the compensation side, we'll flesh that out a little bit more because there are pros and cons for how you do things. And then the second aspect is the actual service. Who does the work? Now, if I go into Ernst & Young, maybe I meet with a partner, but the partner is not the one that's doing my file. That's delved down to a audit manager, and then the seniors and the junior staff do the work. So you want to find out who does the work. You meet with me and you're impressed. Oh, he's a CFA, he's a CPA, he's a CFP, he's got a ton of experience, he's got the right products and services for my needs, meets qualifications, experience, all this stuff. He's a good fit. But then I turn the file over to a junior staffer and I never look at it again. So I might have the qualifications or experience, but it's more important as to who's doing the actual work. So find out who's doing the work on your file or providing the actual advice. Is it going to be the advisor that you met and were taken with, or is it going to be someone else? And if it's someone else, you probably want to, meet them and judge their skill sets to some extent. And I know if you're in public accounting, you're probably laughing as you hear that, because no, there's not likely you're going to get paraded out the junior staff in the initial meetings. The other issue would be third parties. Often advisors specialize in certain areas, and then when something outside their area of expertise comes up, they refer it to a third party. Maybe it's a formal arrangement, so maybe I have a relationship with a tax lawyer or an estate lawyer, and for anything in certain areas, I refer that business to him or her. Maybe I just have a beauty parade, which tends to be the term used, and you say, oh, I'm looking for a tax advisor because you don't offer tax services. And I say, here's 4 people that I've used in the past. I can't vouch for them specifically. You'll have to assess them on your own, but they're 4 people that I have used. So basically you're just saying, here's a list of possible clients, you go assess. And that's a little bit different from in some jurisdictions, a potential liability issue. If I say, go to Joe CPA to do your taxes, then there's sort of that either direct or indirect implication that I'm vouching for Joe's services. And in some jurisdictions, that's a tricky issue. The other issue that I'd be more concerned about, or equally concerned about, is the fee arrangements. So if you're going to provide a overall service and you're outsourcing some of that to other people, is that included in my fees? Do I have to pay them separately? How does that work? If I'm referring you to Joe CPA to do your taxes, is Joe sliding me a little something something under the table for that referral? Maybe he is, maybe he's not. But I tell you, if he is, your advisor has to disclose that to you in advance. And I think that's the case in most jurisdictions, that there has to be the transparency. So if I'm referring you to somebody, you better be asking me if I'm getting any fees for that referral. So again, things like that. And the other thing is, if Joe does a poor job, who do you have recourse against for something that's outsourced to a third party as part of the business arrangement? Do I have to chase down Joe and sue him for poor service? Or are you the one that I deal with? So again, you just need to figure out who's doing the work, what's the fee arrangements, and what happens if I'm not happy. The final area, which we'll cover in a separate episode, is just a comparison of the compensation. And here I'm definitely biased because I do a fee-only business, and so I obviously think that's the preferential way. But there are pros for giving free advice in certain circumstances. Percentage of assets under management is also becoming more and more popular. And in fact, when we look at mutual funds, we see a huge decline in sales commission charged. And one of the big reasons for that move from load funds to no load funds is that more and more financial advisors and banks are moving to a percent asset management arrangement with their clients, where instead of paying for a product, you're paying perhaps 1% of your assets under management with RBC or CIBC or Bank of America. And that covers your fees for a variety of things: credit cards, banking, checking, maybe wire transfers, and discounts on other things. So it's something clients tend to like as well, where I know if I have $1,000 with the bank and they're charging me 1%, then I know what my costs from that investing side or the financial side of my life are going to be on an annual basis. It's not, okay, we're going to charge you here and we're going to nickel and dime you here, and oh, $100 for that credit card, and oh, you want to do a wire transfer, there's another $75. It just gives the client a little bit more certainty and maybe some transparency and ability to plan. So percent AUM is becoming more and more prevalent, and I don't think there's anything necessarily wrong with that. So we'll get into that next time. The final point I just wanted to make today, and I'll make it again when we talk compensation because it's crucial, is get it in writing. Everything you do, every agreement you make with an advisor, don't just say, yeah, that's what he told me, and then find out that there was either a miscommunication, maybe intentional, maybe unintentional, but get the terms of the service. What are the products and services that you're going to be using? What's the process in the distribution of labor? What are the third-party arrangements? Minimize misunderstandings by getting it in writing. And it also serves to safeguard the advisor as well, because often there is an unintentional miscommunication and a client may think one thing that the advisor did not. So again, it minimizes and protects both parties. It also serves as a useful template going forward. Okay, I know how this relationship is planned out. It's in writing. This is the way it's going to be moving forward. There's really not a lot of surprises happening, or there shouldn't be. I think that's a good overview on the personal fit. I think personal fit is something that people don't consider to the same extent as they might technical qualifications and experience. But hopefully you're going to be in a longer term business relationship with your various advisors. So you got to have that comfort level, that trust, and a clear understanding of what they are providing to you in terms of products, services, the process on who's doing what and when. So I think that's important to not underrate when you're assessing potential advisors. Thanks for listening today. Next time up, we'll finish off with a look at the different compensation possibilities for advisors.